For me to introduce three of maybe not only the most senior bankers in Europe, but also the most friendly bankers, as you may see. And it is, of course, from the far end, Frédéric Oudéa, CEO of Société, Générale. It's Sir Philip Hampton, Chairman of Royal Bank of Scotland, and Axel Weber, Chairman of the Board of UBS. And I will be the moderator, but I will even step in as part of the discussion, so maybe it will be a difficult moderation after all. We will do it in the way that we will start with one question where you each get sort of 5 minutes to elaborate, and then we'll try to make it more interactive with questions and answers, and hopefully also from the audience. And the first subject, which I'd like you all to comment on, will be the thing we have heard about all day, all the new regulation and the cost of running a bank balance sheet. What does that make us think about the future business model? How are we changing the bank? What will the implications be? And what will the consequences be for customers? How will they see it? In other words, how will this, in practical terms, spell out in real life? And maybe you will start, Axel.
Okay, well, thank you. Thank you, and it's a pleasure being here. I'd like to thank you for the invitation to contribute to this panel. On the regulatory developments, I think it's clear to everyone that they've become a key driver of banks' business strategies and the models we're using. Regulators have, in my view, had a very big impact on recent strategic thinking at banks, and the one thing we need to make sure is that regulation doesn't become the only driver of bank strategies, because that would risk that all the strategies would look very similar, and that could induce some fragility if banks follow a kind of herding approach and exit en masse some risky activities and all try and focus on similar activities, and therefore compress returns on equity and yields in those activities that they focus on. So there is a certain risk that regulation becomes the overriding objective when you talk about bank strategies. In general, I think banks will become more focused. They will move away from what used to be a diversified, global, and cross-divisional banking model. I can see that banks, and I see it at our own banks, are really reverting to what they define as their core business, and there should be differences in core businesses. They are focusing on things that they are doing best, and they're focusing on markets where they are in leading positions. So when we decided about the investment bank and which areas we do, we really looked at which areas we were a market leader, and we also looked at capital charges in these areas, and we tried to build on our strengths and try to eliminate areas where we were more or less in a commodity part of the market, and really focus on the areas we could do best. I think banks will also see some very far-reaching structural change, driven largely again by regulation. The Independent Banking Commission, the Volcker Rule, the Liikanen discussion, all of this. In my view, banks will reduce their share of activities that require higher levels of regulatory capital, especially where the perceived risks and therefore also the returns of that business are relatively low. One of the problems you will find at the moment when banks discuss strategy, in a very low interest rate environment, and that's where the macroeconomy comes in, a lot of the regulation is still based on normally sloped yield curves, because with completely flat yield curves, the ability of generating revenues, in particular for long-dated engagements, is completely out of sync in the regulatory world with the ability to earn on those activities against much lower yields that are priced in. So banks will exit those areas where they have a real problem in generating sustainable returns. I think banks will also reduce their share of activity that is related to high regulatory capital needs. Rational non-bank players will try and fill this area, and I think you will see trading activity in particular move to hedge funds and internal asset management activities. You will see many of the global banks that have deposit-taking parts de-emphasize their trading operations, and we just did that in a big way at our bank. Overall, I think also there is a pressure for banks to move away from a buy and hold strategy for risky assets. You will see that banks will basically try and hold much less of these assets on their balance sheets, and such assets will be held outside the banking system. And that's why it's very important that two areas of regulation need to be seriously watched, and I want to finish on that. The first one is international regulation. We're seeing regulation become local. That causes a non-level playing field internationally, and for global banks, like all of the ones that are sitting here, working in different constituencies under different rules that are diverging and sometimes developing in different direction becomes very, very difficult. If I look at the number of times we spend on talking about divergent regulation nowadays on boards and in meetings of group executive committees, it's actually more a discussion than how can we meet the regulation that has been done by the BAL committee and is being implemented into national legislation now, is the monitoring of the divergences in the national implementation of these rules. So I'd like to sort of, the first thing I'd like to do is a strong plea for a level playing field and to get back onto that track. It's the only one that is important. And the second one is, there's a lot of debate at the regulators now starting on the non-banking, on the shadow banking sector. I think what I describe now as activities move out of the regulated world into the unregulated space, I wouldn't work on the assumption that all of the non-regulated space is so granular that a default in that area has no systemic repercussion. So I think a certain degree of alignment and coverage of regulated versus unregulated or shadow banking activity is necessary, else really pushing things out of the regulated areas of deposit-taking institutions into unregulated areas doesn't really increase global systemic stability, and therefore might just cause sort of a wrong sense of security once we're done with the banking regulation. I'll try and leave it at that for the first round.
Thank you. Philip?
Thanks. Thanks, Christian. Thanks, Axel, and good afternoon, everybody. Actually, the Royal Bank of Scotland, I think, had the biggest model problems of probably any bank, maybe any financial institution at the time of the crisis, because we were the biggest bank in the world at the time of the crisis, and probably have recorded the biggest losses. We needed 70 billion euros of new capital at the time of the crisis, just to get our capital to a sensible level. And so far, we have probably been the single biggest focus of deleveraging to get our model straight. We've taken 1 trillion euros off that enormous balance sheet in the last 4 years. I don't often talk in trillions, but that's over 1 trillion euros. So it's been a really dramatic restructuring that's underway of our basic business model. We're 4 years through a 5-year program, and I think it will be completed in that 5 years, and then we'll be a very different looking bank in terms of size, shape, and everything else. I'll come on to some of the main issues. The biggest focus, really, as Axel was saying, of our deleveraging has been in the markets business, the investment banking business, which 4 or 5 years ago was 60% of the group and is currently 20% of the group. And I think that's a theme that you will find across most universal banks, the de-emphasizing of the bloated trading explosion that took place and caused such a lot of damage to lots of institutions, obviously most spectacularly to Lehman's and Bear Stearns. And we had a lot of that basically in our model. It doesn't produce long-term returns in my view, and it produces significant high risk, so everybody's been de-emphasizing that. We are now getting towards some of the gold standard elements of the model, I think. If you look at it in group terms, we have decent core tier 1 ratio of 10.3%. We have a loan-to-deposit ratio of 1-to-1. We were massively dependent on wholesale funding. Again, not many people want that now. It's different in different markets for different reasons, but certainly we think that all of our loans eventually should be supported by deposits. And we have massive levels of liquidity compared with anything that historically we've had. The problem is we know what bad looked like. We know that bad is excessive reliance on wholesale funding, bad is having thin capital, bad is having lots of volatile assets that you have to mark to market. What we're not sure about, and I'm not sure anybody that I've heard is extremely persuasive on this, is what really good looks like in the context of a markets business as part of a universal bank. I think, frankly, everybody is feeling their way towards that in terms of size and shape. As Axel says, a lot of this stuff will in all likelihood move outside the banking market. a bank should have in terms of a markets business to satisfy its clients, I still think is unknown. If I can make just a few very high-level points about models. The first thing I'd say actually about banking models is that banks should be strong. This is not always agreed by all bankers, but I think if you have a banking system or individual banks that people can't rely on, can't see their customers through downturns and through difficulties, then you've got the wrong banking system, and it produces second-order effects in terms of business confidence and so on, a lot of which we've seen, particularly in Europe. So I'm firmly in favour of appropriate levels of capital, and let's get this banking crisis behind us, in my view, as soon as we sensibly can. The second thing is the structural issues. The UK banks didn't like the Vickers proposals, mainly because they're going to cost more than the current models, but that's a dead argument now. It's going to happen politically. And the costs, I don't think, are going to be as extreme as they might have been, simply because wholesale funding wholesale funding levels have fallen, and therefore wholesale funding implications of having a separate markets business are probably not so extreme. But the other side of structure, I'd echo exactly what Axel said. This is becoming a mess now in terms of the issues in the UK, the issues in France, the issues in Germany, the issues around Europe. Add on to that what is happening in the United States and intermediate holding companies and what Singaporeans are thinking about. There is almost no recognizable international coordination around a fundamental structure of what banks should look like on a global basis in terms of their interfaces. Third thing, complexity. Again, Axel said everybody's simplifying the models. Banks are still massive and extremely complicated. And that's one of the key reasons why lots of banks keep having lots of problems, is that I have no doubt in my mind that plenty of banks are too big and too complicated to manage really, really effectively. And the implications of that, I think, are now underway. Very few banks are trying to be everything in every market. Everybody is trying to concentrate on what their core strengths are. I do think that's got implications for some of the things that the last panel were talking about in terms of how we get effective international trade finance if some European banks are shrinking their international networks because they can't make on them. And I do think there are macro implications, at least of elements of that. And then finally, if I may, this is a very indeterminate thing, but I think it's hugely important to banks and banking models, which is the question of culture, which is a huge issue, particularly amongst UK banks in the likes of particularly the LIBOR scandals that broke last summer. The banking industry clearly has a major problem of trust, both with politicians, with the media, sometimes with businesses, ordinary customers, and so on. I think a lot of that is to do with the model of pay. That is the thing that gets most people most excited. Still, in my view, hasn't been dealt with effectively in the banking industry as a whole. And whilst I regret the European Parliament's intervention in this and bringing in new regulations where the market might have sorted it out, I'm not actually surprised. I just think it's regrettable probably that the industry hasn't adjusted in market terms as quickly as it might have done. But overall, I'd say, although things are still very difficult, still very challenging, I'm glad that we've moved from chaos to deep uncertainty, if I can put it like that. I think so. We have made progress.
Very good. Frédéric?
Well, speaking as the last speaker, it's very difficult because I must say I agree with my colleagues to highlight perhaps also on top of everything which was said, the issues around the Eurozone. Because first of all, to come back to what Axel was saying, I think it's still amazing to see that every aspect of the regulation is still in flux and fundamentally under deep revision, capital liquidity, organization of the supervision for us in the Eurozone, of course, in particular, with this implementation of a new European Eurozone regulator, organization of the capital markets. If someone in this room is able to describe to me how it will work in Europe in particular, I would welcome the comments. Protection of investors, organization of banks. Philippe was commenting on the differences between the different countries. Resolution, tax issues. May I just say that the financial tax as it proposed by the European Commission would probably simplify our thought process pretty well. I mean, by just destroying the activities, and it goes much beyond the banks. It's for asset management companies, life insurance, and just the corporate world, plus the remuneration. So I mean by this, effectively defining the right business model remains something pretty challenging. And exactly as my colleague was saying, we're saying, on top of that, with a total fragmentation, clearly between the UK, US, and potentially the Eurozone, but even within the Eurozone. So, again, we need to look at this with a lot of humility and fundamentally, definitely moving towards the same directions as my two colleagues. Maybe what I just would like to add, and exactly to comment on what Axel was saying, beyond regulation, still, there is, and there are a few questions. First of all, the behaviors of clients, because on top of all these changes, what is also key to understand is that on the retail side, there are changes of client behaviors with the technology. It's fascinating to see the penetration of the mobile phone as a way to connect. We were just looking at this. Just 5 years ago, basically, there was no connection in our French retail banking business with mobile. Now it is the main source of contacts. It's with mobile phones. So beyond that, there are, of course, changes which needs to be considered on the business models. And clearly, all mature, I think, retail activities are facing this. May I say that what was said also on the environment in terms of interest rates is absolutely critical for retail activities. It reduces margin fundamentally on deposits. May I say also that, of course, when you look at the business model, you have retail activities which I think remains still predominantly local so far, and of course global businesses. And when you think about global businesses, you have to look at the competition. And from that perspective, may I say that when I think about Europe in particular, I do believe at this stage at least that we are facing some kind of handicap with this fragmentation. You know, the US banks have the capacity to act with a relatively consolidated market in the US, large economy, which will grow. For the time being, I must say, in Europe, we are facing this fragmentation and still with probably overcapacity. So when I think about also geographies and the issue of the Eurozone, I can see different scenarios. The one which would perhaps lead to effectively more standardized rules, one regulator, probably more consolidation, or on the contrary, still a pretty cumbersome Europe, which will have difficulty, the Eurozone, which will have difficulty to move forward on more harmonization. And at the end of the day, may I just conclude that if there's today a challenge, and to come back to what Philippe was saying, effectively today it's more deep uncertainty, and a lot has improved since the crisis. A lot has been done in terms of improving the balance sheet and enhancing the financial structure. The key issue is just a question of return on equity. The question we have from our investors is, are you going to be able to have a return above the cost of capital? And may I say, it is not obvious with all the uncertainties we've mentioned. And if you can't, let's say, for a long period of time, it raises a problem for an economic sector. I can't imagine, at least maybe I'm too traditional, but an economic sector not able to compensate, at least for its cost of capital.
Yeah, thank you. I will give a few comments myself, and I think I will take up where Frédéric left it. I think this thing about banks in Europe, as we heard this morning, have built a lot of capital now, doubled the capital base, and en route to get there where we want it to be. Then the next question is exactly the cost of or the return on that capital. And I touched upon it this morning in my opening remarks. I think one key driver in everything we'll do will be capital efficiency. And I think there's much more to be done. At least I can see that we have only just started that journey. Because in essence, it means when a customer approaches us and wants to borrow some money, the answer is not no, it's yes, but. Because that need from the customer can be covered in many ways. If we're really clever, we say, yes, you can, but we need to have this type of covenants, this type of collateral. We need to structure the lending in a way where it requires less risk-weighted assets. And risk-weighted assets times the percentage is, of course, the capital we need. So if we can get down the capital consumption in every single transaction, in every single customer, of course, if we keep up the income level or even nudge it up a little, then we increase ROE. And there's a lot to be done. I have participated in many customer meetings myself where we had this discussion. And the first reaction for the customer is, of course, a bit surprised. What do you mean, structure the deal? But we start to talk about it. What is actually the logic of the customer balance sheet and the customer cash flows? We actually often find solution where we can actually get down the risk-weighted assets. And that will be key to get them down in order to get the return, because I agree with Frédéric, to get a return on this huge amount of capital without becoming much more efficient is really very, very difficult. So I think the common denominator, at least for me, is to secure that we increase our capital efficiency. And to a large part, this of course also means we take down our risk, which is also a part of the regulatory wish. So that's an important part. Another very important driver will be that the commitments which does not logically belong on a bank balance sheet, we need to get onto the capital markets, like it has already been done to a large extent in the US. So there will be a huge drive towards developing the capital market more. So long-term commitments does not really belong on a bank balance sheet with the framework we're looking at now. That's a clear consequence. And I mentioned in my presentation this morning, sort of an 8-year commitment to our corporate customer is not really what we want to have on the balance sheet. It's more or less impossible to get a return on that. So I think the capital markets will develop a lot. And then I also think it's more or less impossible today to describe exactly what business model we will drive, because there are so many dynamic factors. Regulation is not set yet. It develops more or less by the quarter. Pricing in the markets changes all the time. The yield curve changes, and when yield curve changes, profitability of business lines change dramatically. So we are actually in a situation where very few people can say, yeah, in 1 year from now, this business line or this group of customers will have this profitability and we will be able to serve them like this and that. That's a dangerous statement, because the dynamic effects may easily mean that it's becoming either much more profitable or much less profitable. So I think one of the common themes also is not to take too brave decisions, but really to work on the efficiency on capital and of course on costs. That would be the main trend lines I see, at least. Before we open up completely, I have an extra question which you can probably answer briefly, hopefully. There's another set of actions going on, which in particular global cities like we all represent will be faced. And one of them is, of course, the resolution requirements, because there will be recovery resolution requirements for all, but we all know that the G-SIFIs will really be scrutinized here. And this is not requirements will be coming into effect when we have resolution one day, hopefully not, but if it happens one day. It's actually what we have to do in peacetime. It's all the changes in our structure, in the way we behave, in the way we build our balance sheet, which makes it possible to resolve a bank. And that is already going on, and we are, at least in my bank, in real debate now on how it should look. So I think that is also a huge impact, which may change the way we see things. And the other one is, of course, the Liikanen thinking. The thing about ring fencing substantial parts of our core banking business, as I described this morning, which I really think we are talking about. So how do you see this, and do you have some short comments on will these two items, in addition to all the capital and funding and liquidity, will that give further reason to change?
Well, let me start by sort of endorsing something that Philip said after me. I should have done it as well. I've been a regulator for 7 years. I was sitting on the FSB steering committee, the BAL supervisory committee, and I've co-written many of the new regulation that is now being put in place. I fully endorse it. I think it's good to have more capital in the bank. It's good to have better liquidity standards and to put all the things in place, including resolution and recovery regimes. So there is no fight back on these issues. Actually, it's all about doing it, and at our bank it's about doing it as quick as possible and to a degree that is necessary. Now, having said that, We have submitted resolution recovery plans, for your first point, in the US in July last year, in the UK and in Switzerland, in our major constituencies around the turn of the year. We're not just doing the 10% for global SIFIs. In Switzerland, there is a surcharge for Swiss banks, so we're moving to 13% capital requirements that we're doing in terms of common tangible equity. And actually, there is an up to 19% capital requirement for bail-inable capital for CoCos. And it has to do with resolution recovery because we get a discount from the 19% that is bail-inable if we are better resolvable. And so there's a big incentive for us to work on resolvability with all our global regulators in order to have a sufficient amount of capital at disposal if there is a problem in the different constituencies. But that's exactly the first point. It is very hard to see the regulators work together at this point, because for us, a single point of entry global resolution regime with a college of supervisors that work closely together and honor each other's decisions, in particular in terms of decisions between home and host supervisors, is core and key if you want to have a resolution regime work. If the regulators don't work together between home and host and recognize each other's standards, recognize bail-in decision, do this as a joint decision-making process, it's very hard to see how this can work. And so my plea would be really to stay with the single point of entry concept rather than each country forcing banks to have all the capital, all the liquidity locally, because then the whole idea of global banking will go out of the window and it will not be possible to see global operating banks. And it was just said by Mr. Thumann and others, global enterprises need global banks, and it would be a big loss to international trade if that weren't there anymore. Second point on Liikanen and other structural measures. You know, I'm looking at the US discussions about what is proprietary, what is not, what is client related, what is market making. I have a much simpler solution that I could fully endorse. I'm not sure everyone on the banking side would. Simply prohibit and completely any proprietary trading by institutions that are deposit-taking institutions. We've done it already. Most of us that are deposit-taking institutions have exited the proprietary part of many of these tradings, and it's going to get so expensive with capital requirements that 5 years down the road, when it's all phased in, nobody will do it. That would, I think, lead to a much simpler discussion, because then you wouldn't need the structural measures. There are still some areas where you might need some structural sort of adjustments, but by and large, I think the whole issue about the separation of deposit taking versus other activities goes very far, in the sense that there will be a competition about funding in the future. Market funding is not available for banks anymore to the same degree, so sustainable funding sources are going to be much more important. It's the whole philosophy about the long-term liquidity ratios and those new regulations. If you then cut off the part that does trading, and we've de-emphasized that hugely at UBS, so I'm not speaking for our own demand, because we're getting out of a lot of the trading of securities business. But if you cut it completely off, the value of having deposits looks totally different in the calculation of a bank, and your depositors will ask you why deposits don't carry a return, largely because you'll be prohibited from using those deposits in any other part of the activity. So I think coherence of regulation, like liquidity regulation and the separating discussion about Liikanen and Vickers and the Volcker proposal, it needs to be a coherent framework. And I sometimes have the feeling that in these areas, the liquidity and capital regulation has a different philosophy behind it than that discussion. It's very hard for banks to square that if contradicting regulation gets impacted and gets implemented in the various constituencies.
Thank you.
Thanks, Axel. We a few weeks ago made our full year results announcement, and we introduced quite a few strategic changes into the business. As Axel was saying earlier, the regulator actually has been quite deeply involved in the analysis of our business model and our business risks, much more than has been the case for many years, maybe ever. But certainly it's an intensive strategic engagement now with the regulator about the stability and integrity of the business model. Part of that is actually connected with the resolution regime, because of course they want to know what the stress tests look like, and if the stress tests produce some god-awful result, then they want to know how they're going to step in and how that's part of the strategy. I actually think it's, although this is uncomfortable, difficult, pain in the neck sometimes, I think it's not something we can fight. It's certainly not something RBS can fight, given our recent history. We need to work with the regulator to make sure that we do have a robust bank, and in the event that those judgments prove to be wrong for whatever reason, regulators or other people can step in. So I actually think the process is working okay. Some of the outcomes I'm still worried about, as I said in my opening remarks about the balkanization of structures and how it can be brought together in any sort of coordinated way, and it certainly increased costs. But the working programs, regulator by regulator, certainly in our case, I think is working okay. The thing about ring fencing, as I say, we're not fighting that as a principle anymore. We think it produces excess costs or extra costs, which we'd rather not have. But there is an important customer issue here, which is all going to be about the detail of what a ring fence specifically means. And I think this is a huge task, which we're only at the beginning of. Which is a customer wants to deal. If we've been dealing with Shell for 100 years, for instance, they want to deal with RBS. They don't want to deal with a myriad of entities that are created so that we can have an appropriate interface with Shell in different parts of the world. And the same will happen to an individual retail customer, or indeed to an SME. You want things to be simple and uncomplicated in dealing with your bank. And the more structures we have to deal with the handoffs around the interface, the more complicated these relationships are going to be. As I say, I think we're at the start of that exercise, and I hope that the regulators, when they finish that work, have some sympathy with the position of the poor customer, as well as the poor bank, possibly. And actually, we get little sympathy there, but certainly with the poor customer in having dealings that are more complicated than they need to be. I agree with Axel about prop trading. The problem is we all know it when we see it, but getting the lawyers to define it has escaped most of the lawyers, at least that I've talked to. We make public statements that we don't do prop trading anymore, and we've made those statements for a number of years. But from time to time, we hold inventory, let's say, of asset-backed securities for several weeks or indeed some months. Now, we say those are for client drivers and so on, as part of the business. But you could easily take a different view, and how you get those sorts of things defined legally and to regulators' satisfaction, again, it can be extremely complicated.
I will perhaps focus my comment on the Liikanen, because we just had the debate in France. So perhaps the first thing is, when you think about resilience at the end of the day, I think we should keep in mind that the big casualties actually came from relatively simple banks involved just in mortgage and real estate. I mean, we were discussing in France on the parliament when the fourth Dutch bank was nationalized. There was no capital market activities as far as I know. It was a relatively simple bank. Again, when real estate goes bad, commercial and mortgage, you have big amounts and it's very difficult to get rid of that, and the losses are high. After that, we had again this debate in France on capital markets with, I think, still a lot of confusion. And I always try to start from a pragmatic approach. I mean, what we are saying is that in Europe we need more capital markets. Now, there is Basel III. We know that banks will be able to keep less loans for a shorter term, and so we need to have more capital market activities. I think there is a general agreement. The European Commission says that, everybody says that. Second thing is, who do we want to be the players in that industry? And what we've said is that if the Eurozone and Europe in particular thinks it makes sense to have banks which are regulated, which are naturally, I would say, the ambassador of the Eurozone, to be able to compete, putting that in a subsidiary which is ring-fenced does not work. And here, just because, again, the world is not working like this. I mean, when you look at the US, you've had a consolidation process with huge universal banks. And in practice, I don't see single separate subsidiaries competing in this market against this competition. So I think we need to look beyond theory. It could be nice if the whole world was working like this. It's not the case. We've spoken about fragmentation. And on that basis, I think we've explained to the Parliament that effectively the market making, the client-driven activities should remain within the parent company. And I think at the end of the day, what has been decided is to say we will have a segregated subsidiary with, again, no guarantee from the parent company for the prop trading, the non-client related activities, with a screening by the regulator. And may I just say, in practice, when you say it is separate in a subsidiary, I can guarantee you it will be very, very small. Because our shareholders do not expect us anyway to dedicate a scarce resource to something which can be done effectively by hedge funds. So I think it's a way to prevent, and we've explained also to the Parliament that the model has changed dramatically since the last 5 years under the pressure of all the liquidity and capital rules. And I think at the end of the day, it's probably a pragmatic solution which will enable some Eurozone banks anchored in the Eurozone to carry on participating to the reshaping of the capital markets, knowing that a lot still has to be done on also the clearing platforms, which is a way to secure and limit the risk regarding these activities. But again, we'll help these banks to carry on doing their business. And again, in a pragmatic way, I meet with clients, they seem to need the products. They certainly need to need the services.
Thank you very much. I think I will open up for questions from the floor, and quick questions and quick answers from now on will be the theme. Anybody wanting to say something? Yes, over there.
Yes, my name is Rudy Bonte from the Belgian National Bank, a supervisor. I listened with very much attention to the views expressed by the bankers, and maybe I have 3 questions. The first one is concerning insurance companies. We talked the whole day about banking industry, but we realized that there are problems as well in the insurance industry, certainly given the low yield environment actually. So I don't know what are the views of the big banks on this. That's my first question. Second question is on funding. Well, on funding, we think that we still have problems. A mention was made of the balkanization, if I may say, of the funding markets. We see now a slow repayment, a modest repayment of LTRO funding. So what will be the impact of that? And the diverging situation between the big names and the smaller banks?
In a way that long-term funding doesn't cease to exist. So that will be depleted there. On the funding problems, I can only speak for myself. We're a Swiss-based company. We have no retail outside Switzerland. We do investment banking and private banking. We have no funding issues at all. On the SIFI discussion, I think the contingent capital issues are important. I think we need more contingent capital. You know, this was a Swiss invention, and we need a lot more contingent capital. And I've actually changed my mind somewhat since I'm in Switzerland on this issue, because I think the general idea to have a global resolution regime and bail-in capital, if recognition of bail-in is around the globe in every jurisdiction possible, is a good long-term solution. But until you are there, designated instruments with clauses for conversion are, I think, the only practical avenue to move to resolvability. And therefore, I think you actually need COCOs in a transition if you want to have a credible, legally sound bail-in system for global systemic banks. So I think, you know, whilst I saw them as an option in the past, I see them more as a necessity till the global resolution regimes are aligned now. And on living wills, this is exactly what we're doing. We have global resolution regimes that are aligned. The big issue is, and that's playing the ball back to you as a regulator, there seems to be some emerging mistrust among the regulators that basically a bail-in or a resolution decision taken in one constituency, say led by the home supervisor, isn't necessarily sort of taken on board in every other constituency with the same degree of enthusiasm, I would say. Now, that needs to be resolved. We need a team on this resolution regime, on our College of Supervisors. They need to work hand in hand, and we cannot have discussions among the regulators on whether the certain decisions taken by the lead supervisor are productive or not productive in the constituencies that we operate in. We need a global resolution regime, and we need our regulators to work together.
Thanks, Axel. I know the insurance sector's got some challenges, but it's a sector I look at with deep envy from in comparison with the banking sector, because I think they've actually dealt with the crisis, which could have affected lots of insurance companies quite severely. I think relatively effectively. In previous financial crises, the banks and the insurance companies have got into trouble together, but this has been mainly focused on the banking sector. We have the largest motor insurance and home insurance business in the UK. We're in the process of divesting that. So I regret that, but it's something that the European Commission insisted we do as a quid pro quo for receiving state aid, so we're getting on with that. On wholesale funding, rather like UBS, rather like Axel said, our strategy, our business model has been not to rely on wholesale funding. We have no short-term wholesale funding requirements at all at the moment, and we want to keep it that way because we think that's a sound way to structure a bank. We've also repaid all the liquidity support and so on that we got from the Bank of England and other places at the time of the crisis. So we want to keep it that way, and we don't anticipate having problems going forward. On CoCos, I agree. I mean, they're going to have to become, I think, part of the firmament of financing options that banks have, but we all know it's a nascent market. We intend to be in that market over the next year or two, and we expect that market to develop and for it to become a fundamental part of bank financing going forward, as Axel described. And again, on the living wills, I think we're pretty advanced in that. I mean, we've had the really big discussions with our regulators on what we look like and what we do and how we go about things. There is an argy-bargy, if I can use that expression, particularly between the United States and the UK about some of these issues, and some of that comes down to separate structures around our US business, which is very substantial. But I think they will be resolved, and I don't think we'll have any significant disputes until, hopefully, well, unless this happens, in which case we'll have an unidentified dispute, I'm sure.
Very briefly, low interest rate environment, I think, is a challenge, and should be a challenge for insurance companies going forward if it stays like this. So I'm a bit prudent on that in the long term, if you wish, not immediately. Funding, may I say, I'm not sure it's today such an issue, and perhaps for bad reasons, because in particular in Europe, I don't think that the growth of loans will be particularly dynamic. I think people will save money. And so if you just give effectively 2 or 3 additional years, I think the loan to deposit will further improve. On our side, clearly, the situation has improved dramatically. We are LCR compliant. We see money there. No loan growth to be expected going forward. So again, it's not particularly for good reasons, but I don't think it's today such a challenge. And the key issue is really confidence. Confidence at the end of the day in the market. May I just say on living wills and contingent capital, I have the same experience, something like 1,000-page documents. May I just say that I keep always in mind simplicity for both these topics and being pragmatic. I must say I would like to see a structure of capital to remain relatively simple. And I'm a bit worried to add again different layers, including perhaps the bail-inable debt. And I'm wondering how these instruments would work in practice. Regarding living wills, again, absolutely needed. I'm just thinking if the Cyprus banks had the living wills, how it would have worked. I'm not sure that it will cover all situations in practice. And between the theory of taking over a bank in a real mess and really the real situation, there might be certain gaps. So we do that, of course, and it's important, I think, but again, let's keep it simple and deal with that with realism. I think it's important.
Thank you. Any more questions? Yep.
Gentlemen, I hope you don't mind that I raise only different questions than what you perhaps expect here. Sorry, thank you. When I arrived here at noon or afternoon to your conference, I immediately asked the question, what has been the discussion about Cyprus? And they said, no, nothing. So I hope now comes my question, do you mind, since we have the great opportunity to have 3 leading bankers with us, just quickly to give me or us your personal thinking about the most current Cyprus situation?
Yes, that's a very relevant question. I have given several interviews today, and I all thought I would get questions about this conference and our wise words, but they were all about Cyprus. But I will not say anything. I think Axel is probably very, very good.
We're all relying on Frédéric to say something because he's the Euro area bank here on the panel. We're Swiss and UK, and so we're much less closer to the events. And as I said before, it's a very difficult situation. I think, by and large, given the size of Cyprus, my expectation is not that this is a systemic event or threatening to become one. It just shows that something that I've said for at least 2 years since I left central banking and regulation and moved through academia to the private sector. There is no quick fixes. There is no easy solutions around Europe. This will be a long and winding road. It will be an error learning process. And in that error learning process, of course, you do make occasional errors. The whole discussion in Europe about a banking union has 3 parts. One is a single supervisory mechanism, and we've seen some progress there yesterday, and the global banks will all want to see a single supervisor. Way beyond that, there is the issue of a European deposit guarantee scheme, and there is the issue of and that deposit guarantee scheme has to be backed up by European taxpayers. That's not where we are. We will maybe be there in 10 years' time. At the moment, we have national schemes backed up by national taxpayers. And that's, I think, the difficult part that we're seeing now as this unfolds, is the whole debate about a single supervisory mechanism had assumed that there would sometime soon be a European backstop that is available, and it's simply not there yet. And from the debates you've seen, it's very hard to put it in place at this juncture. And so I see some difficult time ahead. There will be risk-off, risk-on periods in the market. We've been pretty risk-on since summer last year, and my prediction was always that after the Italian election and going into the German election, the market and the clients will be a lot more risk-off. And we're seeing that unfolding, so I'm not surprised about this. There's no straight line improvement from here to the end of the year. It will be difficult, it will be volatile, and it's just a timely reminder that the deep underlying structural issues, the deep underlying political and financial issues are not yet resolved. So anybody that had the hope that a simple promise of intervention would solve all the problems is just being reminded that this is not fairy tale land, this is reality, and reality is difficult.
Thanks, Axel. It's the first time I've heard you may be unconnected to the Eurozone, but it's mercifully we have little or no exposure directly there. But I guess my principal observation is it seemed to have been misjudged, the original deal. I mean, we'll see what unfolds eventually. Because the impression it gave to people in Cyprus, and maybe people around Europe, is there was something sneaky going on, because we'd all worked on the assumption that there was a deposit guarantee scheme around European banks that would be of the order of 100,000 euros. That's the sort of messaging, I think, that's been out there politically. And to produce a mechanism which seems to get round that by having a tax levy which has the effect of not supporting deposits, I think has shocked a lot of people. And will produce, I think, some further erosion of trust. Now, if it gets limited or stays limited to Cyprus, we can probably, I'm sure we can all shrug our shoulders. If these sorts of things get real traction and start, actually I can't rely on these schemes, which are unfunded and which are political, then you are potentially into more dangerous territory. So it seemed to me to have been an ill-judged statement, but we will see.
I think, first of all, it was pretty clear that it would be a complex file, and given the nature of the banking system there. And to a certain extent, fortunately, I think the market sees actually the exceptional situation of Cyprus. I agree with Philippe. Second point, that I think it was probably a misjudgment to tax the deposits below 100,000 euros, because I think it's perhaps this which created more reaction maybe than the tax above that, given the fact that we generally, there is this harmonization on this level to protect deposits, and probably the political reaction locally towards that. Third, I think it just reinforces effectively the need to have, first of all, a supervisor which is able to monitor the situation in the Eurozone. And may I say again, here we don't talk about big banks, we talk about small, simple banks. So I think that beyond the large banks which will be directly supervised, it is also important that this European supervisor is able to monitor, I would say, the excess in any country which can come from, just as I've said, simple banks. And fourth, effectively, to potentially then move towards this mutualization, or I would say more solidarity between the different national deposit schemes. I think that once you have a supervisor who has the credibility, who is able to say basically to the governments, look, I have had a look at the banking systems, things have been sorted out. You start with, I would say, a pretty robust piece of paper, you know, the balance sheets are fine, level of capital are fine, etc. I think you can then imagine to move toward the second step, which is effectively a kind of solidarity between national schemes, given everything which will have been put in place to protect banks at an individual level and then at a national level. So I think it's in the reach of Europe.
Yes, I will end this session with one question. I had hoped Michel Barnier would have been here by now, because the question is designed for his ears. But he's not here. We'll do it anyway, because we can all hear it. And that is, we have, all of us said today that we actually support the new regulation and direction. We need more capital, funding, liquidity, and so on and so forth. But after all, if we now had the power, and Michel listening, what is the one or two things we would change or recalibrate in the whole framework of new regulation? What is our real advice to the legislators today from a sort of a banker's point of view, even though we support the general approach?
Well, I wouldn't sort of raise any specific issues, but sort of like to just add one thing. Philip and I could be talking on the resolution recovery regimes and the living wills. Our living will is extremely detailed, because having had a near-death experience, you know exactly what you're talking about. And that's, I think, where the degree of detail that needs to be put into these plans for them to be usable and to work on them continuously to adapt to an ever-changing environment is something that is underestimated. It is treated a lot like a living will. You write it once, put it in a drawer, and you go back to it at some future date. It's not. It's like a tree. It grows all the time. It needs permanent pruning and permanent adjustment, and the amount of work that is needed to be done on that, I think, is underestimated. And I would urge regulators to really focus on the need to keep this living will going and continuously updating, because otherwise, if it's just a plan in the drawer, it will be useless by the time you open that drawer. Second thing where I would like to ask, I have no specific issues that I would like the regulators to change. As I said, I drafted a lot of what is currently being implemented myself, so I would be criticizing myself, and I don't want to do that. The one area that I think is important is, as you go forward, the impression that shouldn't be generated is if regulators fine-tune and adjust regulation that is written because the situation has changed, and it is changing every day, don't discuss that in the media and in the public as if regulators are caving into the banks and their lobbying politics. That's not the way it is. And basically that makes changes that are reasonable and necessary as things evolve a no-go area for the regulators because they would be seen as a result of lobbying policy. So my request would be keep an open eye and keep an open ear to the implementation of what is being done by the industry, because there is a well-meaning industry out there, after all, that wants to become more safe, that wants to regain the trust of the clients, and therefore needs to work with the regulators in getting this right. And having been a regulator myself, there is no harm in listening to the industry and considering some areas where they do have key concerns to maybe ask yourself whether some of those concerns are adequate. Not any particular issue, but keep the dialogue going. My biggest fear is we lose that dialogue, and if we lose the dialogue, we lose a targeted and an appropriate implementation, and that would be the worst world that I think we could face.
Again, as Axel said, I don't think I've got anything specific. I think the direction of travel in regulation is right. I'm sure we'll find in 5 or 10 years' time that some of the specifics are wrong or could be adjusted or whatever, but that's the nature of things. But my main point is actually that cultural point, which is the banks did an awful lot of damage. How much damage, we'll probably never be able to identify, but it's a lot. They're certainly a major part of a prolonged economic downturn in Europe and other parts of the world, and taxpayers have been called on to do things that they shouldn't be called on to do, etc., etc. But at some stage or other, we have to recognize that banks are a critical part of the European economy. They're a critical part of everything we do. They're a critical part of our long-term prosperity. And I think we've got ourselves into a bit of a cultural rut that banks and bankers are bad and therefore need to continue to be kicked to some extent. Now, it's different in different countries, but as a generalization, I think that's true. The Americans have moved on. I'm not sure the Europeans have quite moved on. At some stage or other, I think we need to start to try to have a different attitude towards banks and to try to think of elements of the financial crisis as being part of the past rather than where we are or where we're going. An awful lot has changed from the position of banks 4 or 5 years ago, and I think nearly all of the changes are for the better.
I would also agree with my colleagues. We spent a lot of time discussing on what has been decided and now it is being implemented, but I would focus also on more on what is to come. Let me just say that I have basically 1 or 2 things in mind. On the liquidity, the NSFR, because one thing which is really still of a worry to me is the long-term financing. And long-term financing is needed for growth in the world. Infrastructure financing is needed if you want to see China, Russia, Brazil, all the emerging markets, even in Europe, to grow and be more competitive. So this is one question mark. And secondly, I would like, as Philippe was saying, to a certain extent, really to try to turn the page of the punishment, if you wish, 5.5 years after the beginning of the crisis, and to try really to focus all the energy on the strategy, in particular for the Eurozone. We were discussing about the structure of the banking sector. May I say that the structure of the capital markets, in my mind, is a key issue, and it's still the beginning. And secondly, things, for example, like again the financial tax, because this goes much beyond the banking system. It's about whether the Eurozone or the countries involved will be able to attract capital from outside. I see a world where there will be competition for money, many needs in terms of financing, and really the question for me is, in order to have growth in Europe, in the Eurozone in particular, are we able to attract capital to finance our credit needs? And this is where this tax, for example, could be very detrimental. So that's my focus.
And I will say the focus I would suggest, after having repeated that we actually support the general direction and all the initiatives taken, is probably, as I said this morning, to take one step back and recalibrate. We see countries stacking it up to 13, 14, 15% core capital, other forms of capital 20, and then bail-in capital 20-something %. Nobody have decided those levels. They are just stacking up. I think the intention is good. I think we may take one step back and recalibrate and ask ourselves whether we have to go from 6 to 8% capital to 22, or whether there is a number in between. And secondly, I will strongly support that we create one level playing field in Europe. We see countries by the week now introducing their own measures, and they are all different. Some is about ring fencing in capital markets, some is about local CIFIs, some are about the resolution, some are about the way they interpreted the number of capital numbers they put together, and it starts to look really like a complete fragmentation.